Hello traders, it's Thomas here from VAGAFX, and in this video we're going to be looking at liquidity sweeps, how to anticipate them, when to use them with our setups, and when to avoid the market altogether. If you do enjoy the video, it would mean the world if you hit that like button, and if you did want to stay updated with my latest content, you can subscribe and ring that bell button. Now, without any further ado, let's get straight into the video. I hope you guys enjoy. Guys, before we can start looking at examples of when to utilize this, we do have to define what liquidity is, just so we can use it within a trading strategy without discretion. Now, the two liquidity models that I do teach 3 in total, but the two that we use without discretion in our trading plan are equal liquidity, which obviously will build up in a horizontal fashion, and then we also have diagonal liquidity, which will build up in a diagonal fashion. Now, when liquidity builds below price structure, guys, we call this sell side liquidity. When it builds above price action, we call this buy side liquidity. Now, when looking at equal liquidity, guys, we only look at liquidity or market structure that has tapped a equal trend line or a horizontal trend line twice or more. Now, we say twice just because 1 point isn't enough liquidity build up for us to worry about. When there is 2 taps, guys, we know that there is a nice amount of liquidity being engineered by the market, which will likely sweep at a later point. And obviously, the more points structure taps that we get, the more liquidity builds up, the more the market is likely to sweep that. They do say that support and resistance does get stronger with each tap, but when you understand liquidity, you'll know that there's more liquidity building up. It actually gets weaker over time. With diagonal liquidity, what we'll look at, guys, is 3 taps of a trend line, and these will have to be perfect taps, otherwise we are using discretion and we can't utilize it within our strategy. Now, with diagonal liquidity, guys, in an uptrend, liquidity will only be building below each higher low, and in a downtrend it will be building up above each lower high. And that's because on the other side, guys, all the liquidity that's building up above each point is getting tapped with each subsequent break to the upside. Now, we can also use liquidity without discretion by using time-based liquidity. So in my community, I do teach my students about localized and historic liquidity. Localized will build up over a short period of time. Historic will build up over a larger period of time. So say we've got liquidity that is built up over a few hours, guys. Let me just delete all of this. Say that liquidity is built up over a couple of hours in a horizontal fashion. We actually know from backtesting and looking at years of data that it will actually look to sweep this liquidity, but it will often, more often than not, reject afterwards. If we actually know this, guys, we know that the market is likely to sweep before rejecting. We can simply decrease our exposure rather than having our order set on a supply zone below. We can look to increase our entry points higher. We can also look to increase our stop loss. So this will still allow us to enter zones aggressively, and we'll still get into the market at favorable regions. And you will actually see now that it actually allows us to get into some high returning trades by doing this. So say that the market has actually built up over a lot longer period of time, say over the space of days, if not weeks, we know that the market is less likely to reject after sweeping. And what we can then do, if it does reject, is we can look to get in on a confirmation on a fresh supply or demand zone. Guys, we're going to look at some hand-picked examples now on the Eurodollar. Now, I say these are hand-picked. They are also recent price action, just so you know that this does play out quite a lot, and we can take advantage of liquidity in many situations. Now, say we're waking up before the London Open, guys, and we're going to be doing a fresh analysis on the chart. We can start drawing structure first, just to get an idea of the momentum of the market. We can see this is the highest point of the visible price action. We know that this is going to be a swing point, and then we just simply need to work our way backwards. We can also confirm that this is a swing point by seeing breaks of structure to the upside, breaks of structure to the downside. We're going to just label this as a swing high, guys. We're now going to follow the market back just to find the last swing. We can see that there was breaks of structure to the downside, breaks of structure to the upside, confirming this as the last swing low, which we're going to draw. We can also see that there was clearly a swing point here. Structure breaks to the upside, structure breaks to the downside. So this was the last swing high. And this confirms to us, guys, that the long-term momentum is bullish. So we know that the swing low is likely protected, the swing high is likely to break next, and that's just because of expectational order flow. Now we can actually see, guys, if we were trading the previous day's price action, that the market has entered this demand zone and rejected it very aggressively. It's filled all imbalance to the downside, and it's left more fresh imbalance to the upside by here. So we know that there is likely still unfulfilled orders by there, guys. So we would be looking to potentially trade from that zone. But if we actually look to the left of this price action and we draw this across, we can actually see that we've had 4 taps of this diagonal trend line, guys. And this has happened over the space of around a day. We know that this is now historic. The market is likely to sweep this. Now, it can sweep before continuing order flow downwards, guys, or it could sweep and continue upwards. We're not going to enter this aggressively. We're going to actually wait for a confirmation entry. We draw a demand zone across. We're going to draw it from the last trend candle. We can actually see that there's liquidity building up by here, guys, as well. And by here. So we know that the market is intentionally trying to move down here. We don't know if it's going to continue downwards and break this momentum to the downside, or it's going to sweep this liquidity for continuing its original order flow. Let's see what happens, guys. Now we've had a sweep, guys, and we've had a sharp retracement back upwards, back into the demand zone. This first hint that the market is sweeping before rejection. What we can do, guys, is look for a order flow reversal. So we do have a structure point that's been marked here, guys, but it's actually in between the major high and low of this range. So this would be a major high. This would be a major low. This is a minor high that's occurred between. For this to count as a major high, we would have had to get a structure break to the downside and then a break to the upside, which would confirm that. Or we can have one more structure break to the upside, followed by another structure break of minor structure to the downside, and then we get that break. And this is significant enough for us then to classify it as an order flow reversal. But now, if this just breaks to the upside, we're not going to look at an entry point just because we count it as substructure. We're going to keep playing price. Now we've had a break to the upside here, guys. We get a reversal. This becomes our significant structure point. We get a break to the downside of another minor point. So what we can do now, guys, is draw this across. We actually classify this in our community as a minor swing high. We get a break of this to the upside. We can then look to long from a fresh demand zone that's been printed here. We're going to play some price action now, guys. And we get a break of the minor swing point. We can follow the imbalance back. We can see all of this is unmitigated, and we've got a fresh demand zone here. Again, this is just going to be the last counter trend candle for all unmitigated imbalance. We do use mitigated imbalance in some circumstances, guys, but I won't cover that in this video. Now, there's going to be a great deal less liquidity built up by here, guys, than there was by here. So with this, we don't even need to have a large stop loss. We know that the demand zone is fresh by here. There's a lack of liquidity. We can actually trade aggressively with a very small stop loss, just so we get a really nice return on this trade. And then what we'd like to do, guys, is target the swing high, just because we know that the momentum is currently bullish, and buy side liquidity building up above. Zone. And the order flow continues. In this last example, guys, we're going to look at using liquidity to avoid the market. I've already taken the liberty of marking up this structure just because it was quite rangy. I did mark this up in a previous video if you did want to go back and look at that. We have a swing high by here, guys. We actually had clear liquidity inducement for that. But if you look at the whole price structure that's been forming, we can actually see 3 perfect taps on here. If you were looking to enter from this zone, you'd want to choose the last order block before imbalance, which would be by here. We can see that there is mitigated imbalance by here, but it is historic. I'll be using that. We've had a tap, guys, already. At this point, the market is rejected from that order block, and you may have got involved in this without seeing this, just because obviously this has been drawn in hindsight. At the time, though, you wouldn't have actually seen this liquidity built up on the chart, or at least you'd be less likely to. You have, however, got localized liquidity built up by here, although it is quite messy price action, but we do get 3 nice taps on this liquidity. You'd actually be looking to enter this higher, at least enter with a larger stop loss if you were going to be looking to get involved on this zone. But once you've had this tag, guys, we can clearly see that there is triple tag onto this larger diagonal trend line. But at this point, you'd be looking to mitigate your risk by simply moving your stop loss to break even, or if you were that concerned, you could look to close out your trades by here in profit. You have also got some liquidity building up to the downside by here, so you could be looking at potentially getting more out of this trade, but you'd at least want to move your stop loss to break even, just to lower your exposure to the market after seeing this large build up. As we can see, the market did decide to sweep all of this liquidity. The VAGA Academy is up and running, guys, and you can get access now through the link in the description. It includes all the knowledge I've picked up on over my 7 years of trading, and you can be one of the first to learn my simplistic single time frame approach to trading the markets. The course covers 4 hours of content, including my blueprint on market structure and the free setups that I trade personally, and you also get access to the premium community, which includes daily support and price discussion from members trading the same plan, and also weekly forecasts and breakdown videos from myself. I hope you have a lovely trading week. I will catch you in the next one. Peace out.